It's simply a fact that filing a timely and accurate Form 990, it's essential to the ongoing success of your nonprofit. What's interesting, though, is that we often run into this false notion that the IRS, they don't really care or pay that much attention to what's being reported on Form 990. Well, here's a news flash. They do care and they do pay attention. In fact, Form 990 can be the very thing that generates an audit of your organization. Hi, I'm Greg McRae from Foundation Group, and welcome to 501c3 University. Today we're talking about IRS Form 990 and getting audited. Fun stuff, right? But before you tune out, I encourage you to stick around. What I'm going to be talking about in the next few minutes could spare your nonprofit some really serious grief. The truth is, there are several situations that can trigger an IRS audit of your nonprofit. What most nonprofit leaders don't realize, however, is that Form 990 is the primary trigger for IRS audits. In fact, the IRS computer system, it's got built-in analytical tools that looks for certain data points and inconsistencies. Raise the right flags, and there might be trouble ahead. Let's look at the top 10 Form 990 audit triggers in no particular order. Audit trigger number 1, failure to file a complete return. Filing an incomplete return happens quite a bit when you have someone preparing Form 990 that, how do I say this kindly, doesn't really know what they're doing. But the fact is, we've even seen this happen with tax pros who aren't all that well versed in nonprofit rules. Usually, though, it's returns prepared by an employee or a volunteer of a nonprofit, and they're doing this so that they can save money. Look, Form 990 is a complex return, especially if you're filing the long version. Not every incomplete return is going to result in an audit. It really depends on what was left out. The problem is that the IRS regards incomplete returns as if they were never filed. That means if you don't file a corrected return by the due date, the incomplete return will be tossed out, and late fees will start piling up as if you never sent in a return at all. Audit trigger number 2, acknowledging a diversion of assets. Part 6, line 5 asks an interesting question. Did the organization become aware during the year of any significant diversion of the organization's assets? Now, if you don't speak the IRS's language, this sounds kind of odd, doesn't it? Diverted where? What the IRS is looking for is if somebody embezzled money or anything that may have resulted in the nonprofit's money or other assets, for that matter, being diverted to personal or otherwise inappropriate use. A yes answer to this question requires a detailed explanation of what happened and how it was remedied. Even with an explanation, an audit is possible here. Without an explanation, it's virtually certain. We had it happen to a client who prepared their own return and answered yes to this question accidentally. Painful lesson in the cost of do-it-yourself. Now, if your organization experienced such a diversion, don't answer no out of fear of audit. Always answer truthfully. You're filing under penalty of perjury, after all. Audit trigger number 3, acknowledging prohibited political activity. Part 4, line 3, and Schedule C, Part 1, ask whether the nonprofit was involved in any prohibited political activity during the prior year. Now, this question is primarily aimed at 501c3 organizations to see if they participated in any campaigns for public office or had excess lobbying activity. By the way, in case you didn't know, 501c3s in particular are prohibited from getting involved in campaigns. Again, a truthful answer here is necessary, but know ahead of time that a yes answer could spell trouble. Audit trigger number 4, unrelated business income. Unrelated business income, or UBI, that's any income a nonprofit generates from an ongoing activity where the activity is not directly related to the organization's exempt purpose. Think of it as commercially generated income by a nonprofit. Now, this is taxable revenue. That's assuming your organization actually turns a profit on it. And UBI is something the IRS scrutinizes pretty heavily. Too much of it, and you can lose your 501c3 status even. So that's one potential area of audit, too much UBI. The IRS doesn't actually say how much is too much, but a good rule of thumb is anything over 20% of total revenue may spell trouble. Another way UBI can trigger an audit is reporting it on Form 990, like you're supposed to, but failing to file a required Form 990T to calculate any potential tax liability. That pretty much guarantees an audit. Audit trigger number 5, acknowledging excess benefit transactions with disqualified persons. Excess benefit what? Yeah, I know, but don't check out just because it sounds mind-numbingly technical. This is the perfect example of a question that novices won't likely understand, and a yes answer to Part 4, lines 25A or 25B, that's a big audit target. It may also trigger some nasty penalties called intermediate sanctions. Now, this can get so technical that a video like this isn't the best place to try to explain it. If you want to understand this in more detail, we've got a link in the description below to our companion article. The plain English version is this: monetary or other benefits provided to those in power, officers, directors, key employees, or anybody related to those people, in excess of reasonable employee compensation is prohibited. Acknowledging that such a thing happened, while necessary if true, is a massive audit trigger, as well as the potential for monetary fines levied directly against board members personally. Nasty stuff. Audit trigger number 6, unreasonable compensation. The IRS requires nonprofit salaries and wages to be reasonable. The problem is that the IRS does a very lousy job of defining what reasonable means. It's more of a we'll know it when we see it sort of thing. But the best way to understand it is that employee compensation should be comparable to other similar nonprofits. It should also be objectively tied to the job description and be within the organization's ability to pay without hindering the ability to carry out the nonprofit's mission. Form 990 lists your highest compensated employees and their wages. The IRS looks at this reasonableness question 2 ways. Is compensation excessive? If so, they may determine that the organization is really focused more on individual gain and not really public benefit. This is one of the top audit triggers, so beware. And number 2, is compensation too low for the size and budget of the nonprofit? While this is less likely to generate an audit, it can happen. Audit trigger number 7, foreign grant activity. U.S. nonprofits are allowed to operate in foreign countries. Thousands do it. U.S. nonprofits can also grant money to foreign charities. The thing is, though, foreign activity is a heavily scrutinized area by the IRS, mainly because of the risk of having a U.S. charity be under the shadow control of a foreign entity that the IRS really has no jurisdiction over. It's actually a very big deal. The IRS requires information about foreign bank accounts, activities in foreign countries, and foreign organization grant making. Anything that may indicate a lack of U.S. control is a big audit trigger. If your nonprofit has foreign activities, please work with a professional compliance team like Foundation Group to ensure you're doing things the correct way. Audit trigger number 8, fundraising income and expense discrepancies. Schedule G of Form 990 is where nonprofits report income and expense activity for each individual fundraising event conducted in the past year. It is also a source of potential audit. One of the things the IRS looks for is inconsistencies in income and expenses. So if your nonprofit reports a hefty income, but very little in the way of expenses for that same fundraiser, it does raise a flag. What's even more problematic is in reverse. It's common to see an imbalance, especially when a big donor comes through and really pushes your fundraising effort through the ceiling. That's a great thing. We always want to see that. Expect more scrutiny, however, when it goes the other way. Big expenses, but little revenue, resulting in a net loss on the campaign. The good news is, of all the audit triggers we're going to talk about today, this one happens less frequently, but it is something to be aware of. Audit trigger number 9, non-employee services, but no 1099 NEC. So what are we talking about here? This is actually a fairly common occurrence, and it can trigger inquiries in extreme cases. And it usually goes like this. Your nonprofit reports on Form 990 that it paid independent contractors in the past year, but you did not distribute Form 1099 NECs to these vendors as the IRS requires. Not only does that subject your organization to a penalty per 1099 that didn't get filed, but it can also raise a red flag with the IRS if the amount of non-employee compensation is relatively high. First, make sure your contractors really are contractors and not employees. Big mistake that organizations make. Second, if you do pay contractors and they really are contractors, That needs to be reported on 1099 NEC before January 31st. Audit trigger number 10, loans to disqualified persons. Congratulations, you made it to trigger number 10. Our final top 10 Form 990 audit trigger involves loans to disqualified persons, better known as your officers, directors, or key employees, plus a few others. First of all, a nonprofit lending money to an insider is considered unethical at best. In most states, it's also illegal. What's interesting here is that while it may be against most state law, it's technically not against IRS regulations federally. That said, Form 990 does ask specifically if the organization has lent money to a disqualified person. That can be enough to raise concern. The real audit trigger, however, is failure to see that loan receivable number on your balance sheet decrease year over year. Let's look at an example. Let's say your nonprofit's board president, Jim, he borrowed $20,000 from the nonprofit. Let's assume it was not against state law and a legal contract was signed, including a stated interest rate. Well, if your Form 990 shows that loan outstanding at $20,000 and next year's Form 990 doesn't show a decrease in that amount, what it's telling the IRS is that the borrower, the insider, isn't paying that loan back. That is a prohibited private benefit, and an audit very well may be coming your way. Are you ready for some good news? The IRS audits relatively few nonprofits each year. But for those who are unlucky enough to get an audit notice in the mail, you can expect that Form 990 problems, well, they were the most likely cause of it. The remedy is to work with a tax professional who knows these triggers and can help your nonprofit avoid the headache of a visit from Uncle Sam. Well, that's it for this one. If you liked this video, please click that like button. It really does help us to get this out to more people. Also, be sure to subscribe and finally click the little bell icon to be notified of new content. Thanks for watching, and we'll see you next time.